listening to the Lord and Richards Show, and this is Colin Richards, president and founder, and I'm thrilled to be with you today talking about one of our core values at Lord and Richards, which is to manage risk as a steward. And we've been dialing that in from Proverbs 3, 5, and 6. For those just joining us, you can always find more about us at lordandrichards.com. And so as we learn about trusting God instead of ourselves, to not lean to our own understanding, but to acknowledge Him in all our ways, we learn that even in the area of finance, God's going to direct our path. And that really applies in the emotional area of financial decision-making around investing. You know, when we get market volatility, you begin to see that the average person is going to tend to respond emotionally. No matter how logical they want to be, it just comes up. And the question is, what are you going to do with that emotion? Well, let's start a little bit by talking about what market volatility is. You know, volatility is when markets suddenly start swinging around, going from one extreme to the other. And while we're loving it the whole time that they go up, we definitely don't love it when they go down. And sometimes they go far enough down that we enter what's called correction territory. Now, you might wonder, what is a correction? Well, technically speaking, anywhere from 5 to 9% down on your portfolio, or if we're talking about the market or one of its indices like the S&P 500, 500 strong equities in the United States, or a bond index, or the NASDAQ, or a foreign index, whatever it is, if it goes down 5 to 9%, then it's in a pullback, okay? Now, if it goes beyond that and it's 10 to 19%, we call that correction territory. And we see a lot of those. We see a lot of corrections. And then if it goes beyond that and it's 20% or more down, that could be 20, 30, 40, 50, whatever, then we call it a bear market. And the fun thing about that is that Wall Street has a bull out there on Wall Street, but you can't find the bear anywhere. It's like you guys really only have one side to your thinking, don't you? It's funny, you're always looking at the recommendations. Well, maybe you're not, but when I look at their recommendations, they're always saying buy. They're never saying sell. So let's put that into context. If we're talking about volatility, corrections, market swings, there have been 27 corrections in the S&P 500 from 1945 till this year. 27 of those. That's somewhere between minus 10 and minus 19. That's a lot. That's a lot of bad years, as we might call it. That's an average, if you want to know, of one correction every 2.8 years. So about every third year, we're coming back into correction. We're losing 10 to 20%. And what is surprising is that folks act as if that's completely unforeseen. How could we ever, have that happen? And particularly when we look at portfolios, a lot of times folks will really react negatively over just a couple of percentage points drop, when probably what we need to do is educate folks more about how this is going to happen. It is going to be part of your world. And as Warren Buffett said, if you can't afford to own a stock for 10 years, you shouldn't own it for 10 minutes. Probably need to be in cash, right? Because if your stomach is going to react from 2 to 5 to 10% to 20% in a negative fashion and cause you want to hit the road with your portfolio, the stock market is going to be a tough place for you. The people who say they figured it out, you can invest in stocks, liquid investments, and never experience declines, that's just not true. Now, there are safe investments, and we talk about them here, but we're talking about the regular stock market. And so how about from the period of time from 1974, 1974, 5 of those market corrections that we experienced, from 1974 until now, have been bear markets, 20% or more, okay? So that gets to be a much smaller period. Every 7 to 10 years, we're going to see a serious drop. You say, I can't handle that. Then you might not want to be in the market. Now, the good news is there are ways to mitigate losses, to manage risk, and that's what we put into a risk management plan, a written risk management plan, so that we know as we test your portfolio, as we take it through real historical time periods going back in the past, and as we test out into the future, pretending all kinds of good and bad things happen, we can guess kind of the range of possibilities of both positive and negative in your portfolio. So it's important to know that. So we've experienced plenty of corrections and bear markets in our time. What causes that? Well, a lot of times folks are just taking profits, right? The market's gone up long enough in their estimation. And what they don't want to do is risk the possibility that all these gains will not be realized. Folks who buy and hold forever and never realize a gain just because maybe they don't want to incur a tax are missing out. And so people will take money off the table in order to realize those gains, put money in their pocket, and then go reinvest elsewhere. Corporate earnings come out, and maybe there's a little bit of bad news and everything swings one way or the other. Technical analysis traders are out there, and they're just basing everything on the fear, the emotion, the swings of the market, what people have done in the past. It's not really based on the fundamentals of any company. Two big ones that we've seen a lot of over probably our lifetimes. If you're listening in today, you've probably experienced the 2008, 2009 market crash, the 2000 crash. And a lot of times there's a black swan event. It's totally unforeseen. How about a pandemic? How about a war? How about 9/11? Black swan events. Or just normal things that come around that creates fear. That's the big factor. There used to be a show called Fear Factor, and people would do all kinds of crazy things. If you don't like fear, then you need to stay tuned because we're going to help you learn how to deal with that. And I'd love to talk to you about that because I think there are really some smart things you can do. And my team and I are helping people every day to develop a plan to make sure you don't have a bottomless pit underneath your feet, but to put a floor, to put a net under your feet, to build a written risk management plan so that you can sleep easy at night, so that you can have a portfolio that reflects how you feel about risk, not just what an advisor thinks. I'd love to visit with you. I'd love to learn more about your goals and see how we can help.